Yep. Good thing they never hear me sing. Welcome to the closing beat, everybody. Happy Tuesday. How you doing out there? Back this thing up a little bit. Oh, I left my bag of candy. That was my bag of candy. I was trying to clean up a little bit. There you can tell it's not a green screen back there, huh? Hey, welcome to our show. We call it the closing beat to play off our name, Jazz Wealth. We are financial advisors that are just laid back, man. I mean, with no suit and ties. You could tell I wear the same thing every day. Just trying to make the focus on your dollars rather than, hey, look at me. We're impressive financial advisors. It does nothing for me, man. I hope y'all are having a good day, and it's not raining where you're at. It's been a little nasty here and from last night all the way into today, but thankfully not raining too hard now. Hey, our FinTips videos, we do those. Those are actually posted on our YouTube channel. You can check them out. Today, I took a little different approach. We went through 4 types of retirement wealth, but I actually used the big words for each type. So that if you want to research it, you can research it yourself and learn a little bit. Or if you're going to work with an advisor, if it's us, thank you. But if it's not, then at least you know kind of how to sound smarter, right? So they treat you a little bit better. Not that they're bad, but you know, someone doesn't sound like they know what they're talking about. Sometimes you don't get the goods out of them. So help you out there. Be sure to check that out. And thank you to all that have. Apparently that was one of our better performing videos here lately. And unlike Eric, I said everything correctly. Anyways, we're going to talk about the stock market here today. Oh, by the way, go in our notes from Jazz. If you're one of our clients, I put a really cool visual. It took a while, but I was trying to show the market performance before, during, and as recessions happen. So you could see. I often tell clients, stock markets bounce in recessions. And I don't know, this is technically a recession, but I guess we're just not going to call it that. So I show that, right? You never want to react based on the presumption or the official declaration of a recession, right? So check that one out there. Anyways, boy, you got a lot to look forward to for the rest of the week. Tomorrow starts off with the inflation numbers called CPI, and then there'll be another one called core CPI. 2 weeks ago, I did a great piece in the notes from Jazz email to explain how CPI is affected by energy and food. Well, how is core CPI? If we back out energy and food, what's the big weight there? What's going on? And I made the point that, you know, inflation is going to peak one way or another. So I showed you that one there. We'll see what happens. You know, it'll come out before the markets open there. The expectations, now this is interesting. I'm going to share some data with you here. The expectation is for inflation to decline to basically 8.7%. Some are at 8, let's call it 8.7, right? We're at 9.1 right now. That's the CPI number, not core. So the inflation, or the expectation is that we come down a little bit, show a peak. So think about this. This gets confusing. We're at 9.1. The expectation is 8.7. So if we come in at 8.7, that would be considered in line with expectations. In other words, we did peak. If we come in below 8.7, that's considered better than expectations because we want the lowest number possible, right? And anything above that would be considered higher than expected, even though it could be 8.9 or 9.0. That's technically lower than where we're at now. It's actually worse than expected. So that tends to get a little confusing with people there. The core CPI is going to be the focus. I imagine CPI get a little more attention because oil's pulled back, so people like to see that. We're expecting to see a 0.5 point increase in core CPI, which is still a lower number. We're still going down. We would only have an increase of 0.5% versus 0.7, which is where we're at, or what's expected. All right. So think about it. If the markets see a inline or lower than expected CPI number, what do you think would happen? You would expect the markets to rally a little bit because it'd be expected that the Fed could wave their hands in the air and say, we're doing the right thing. So maybe we don't have to do as much of it. Maybe we raise rates a little bit slower or not at all. I don't think that's very probable, but that could be the case. If the inflation number is higher than 8.7, then that means the Fed has to say, what we're doing is working, but it's not really working as well as we'd hope. So we have to be more aggressive. It means higher rates. It means tech stocks will be a little bit beaten down. It means a wild ride for the stock market. Now, the data that I want to share with you here is what does the stock market do when those numbers come out? And so we have to break this down. What happens when they come out as expected, better than expected, worse than expected. And so let's go with this here. Ta-da. All right. So we're showing two different things here because there's a difference between what's happened on average over the last 10 years in black and what happens really just over the last year, because it's really been an outlier in terms of how they raised rates. So here we go. In line, meaning it was just as expected, the stock market gaps down up 5 basis points over the last year. That's not percentage, that's 5 basis points, 0.05%. If you look back over 10 years there, whenever we have an inline inflation expectation, the market gaps up by about 0.1% or 0.09%, if you want to say it that way, or just round up. Here's the interesting one. When the inflation numbers come in greater than expected, the market gaps down an average of 0.5%, 0.5 essentially if we round up. So we don't want to see that. That leads to negative performance over the last year. It's very easy to go look that up. Over the last 10 years, what still doesn't like it, we gapped down by about 0.25%. And historically, if you look at this one here, I don't have this chart in front of me to share with you, but historically, when inflation numbers are worse than expected or greater than expected, the stock market gaps down by 0.25% and immediately tries to gain that back, but unsuccessfully, right? So I just wanted to share that with you, give you something to take a look at, because inflation is the hot topic, not just with the CPI numbers coming out, but with the Inflation Reduction Act that is also coming out. There's really no mention of inflation or focus on how we're going to combat inflation in the Inflation Reduction Act. It should be called like the, Carbon Reduction Act or something, but that's a highly debated topic there. It's a lot of green energy stuff there and a lot of increases in various taxes, although they're coming off minute by minute. I should point that out. So anyways, we'll be hearing more about that. Doesn't really matter where you stand on that one because that's widely expected to pass. But you can expect that share buybacks would actually continue through the end of the year and then freeze up. Like Congress is expecting to make literally tens of billions of dollars off share buybacks, the 1% that they're going to charge on the bigger companies there. And I bet you they just don't do it or just pay dividends. Anyways, let's take a look here. We got the S&P today. I rambled a little bit. I'm sorry about that. Today, the market's still hit by semiconductors. It's kind of funny. NVIDIA took their shot yesterday and said, ooh, things aren't looking good. Well, today it was Micron. They said, ooh, things aren't looking good. We'll cover that in just a little bit, but semiconductors do control quite a big piece of the S&P and the NASDAQ as well. Let's go over here, do this. There we go. So we got that. And so when you look at the S&P today, it was always going to struggle to move higher. And you could tell that because if you look at, where are we at here? If you look at the stock market trying to rally, but semiconductors not, well, it's hard to do that. You'd need the entire rest of the market to help move or offset the loss in semiconductors, and it just didn't happen today. So really early on today, you could kind of see, we're just not going to get anything done. It is okay because we've been talking about this area of major resistance, an area where the glass is exactly half full or half empty. So you know that there should be some confusion here. If you go back to last week's lessons, you can see us explaining why that was going to happen, and now you can see it in real time happening. It's not crystal ball type stuff. It's just investor, trader psychology, whatever you want to call it there. Anyways, so one thing that did happen today with the semiconductors, you did have the negativity pulling Intel to new 52-week lows. That would be the only one, but it was still pretty brutal for AMAT, which we talked about yesterday, and then like names like KLA, 10 Core, etc., really just beaten down today. So if you've been looking at the semiconductor industry for ideas there, maybe there's something there for you, or at least starting to form for you. The NASDAQ is the same exact thing. Yesterday, for a brief moment, we did technically hit a bull market, but it does not count unless we close above, it'll be exactly above, if you're looking at the futures here, it would be above 13,419 and a quarter. So we got a little bit to go there, likely going to pull back or chop around sideways before we do anything. So before today started, we had exactly 1% to go. After today's close, we have exactly 2% left to go. So a 2% rally would actually put us into a bull market for that. It was not going to happen today. Also, the NASDAQ, by the way, if you like the geeky stuff, the NASDAQ is the only index to have a net long position if you look at the futures market. So there's something that's called a commitment of traders report that comes out. I don't know when it comes out. I just caught the report, so I don't know if it came out yesterday in the morning or the afternoon, and you look it up. 9.4% net long interest, which basically just means 10% of the participants are betting that the NASDAQ will continue higher. That's not the case with the other indices. If you were to look at the S&P, you would use the E-mini S&Ps there, or the SPX, I'm sorry, I said that wrong, minus 10% net long interest, which essentially means that 10% of the more than 10% of the participants from the flat line are betting on the S&P to continue to head lower there. The Dow is at 25% to the downside, right? So a quarter of participants above neutral, right? So you got your longs, you got your shorts, you put them all in a pot and you go, well, what is the end result? Are there more shorts than longs, more longs than shorts? You get what I'm saying. 25% betting on the Dow to actually hit lower there. And that's easy to research. It's just called the Commitment of Traders Report if you are interested in the futures market. One of the other things I'll point out is the old Russell. It erased all of yesterday's gains, pulling back there. I don't mind so much, although I was kind of excited to see the Russell moving on its own accord. So we're back into slosh land. The Russell has a mind of its own. It sometimes participates, it sometimes does not. So I don't have a great clear reading on that one. And whenever that happens, you sit on your hands, right? You sit back and say, well, I don't need to do anything. I can just hang on to my money. Crude oil basically flat on the day. Not much else to say elsewhere. Gold pretty much flat on the day. Bonds were mixed overall. So I don't need to get you excited about anything there. Okay. One other thing that's maybe not stock market related, but it has to do with your credit cards, man. What y'all doing with your credit cards out there? Still spending the dough? Check this out. Revolving and non-revolving debt levels. Here is this is the cumulative number, right? So U.S. total revolving credit outstanding, $1.12 trillion. That's a new high. So naturally, here's COVID, and then we're making our way all the way back up here. The amount of how do I say it? The percentage of revolving credit card or revolving debt that the average American has is now 6.05% of their total personal income. Is that high? Or is that low? Right? It's actually not bad. All leading up to, but not including COVID, we floated right around 7%. The highest was back in 2000, where we were almost at 10% of our total personal monthly income being spent on credit cards. Kind of fascinating there. Non-revolving debt is very similar. That is pretty consistent in terms of a number there. The average outstanding non-revolving debt is almost to a new high in terms of your personal income. About 20% of your personal income on a monthly basis goes to non-revolving debt. That's your mortgage, right? So that's not so shocking there. It is at an almost all-time high there. The all-time high is like 19.5%. So either way, we are out there spending money, getting back at it. You guys want to spend that money. What's fascinating to watch is the percentage of credit card debt relative to your income obviously fell during COVID, but it didn't rally back to new highs. Why is that? Because we all took the free money that the government gave, I'm assuming you, and you paid your credit cards down. You know how many clients told me, like, hey, I got $1,200 from the government. Cool, I'm just going to pay down my credit card. And then we didn't go out and spend more money on our credit card. So good job on that one there. But it looks like instead you went out and spent money on houses and non-revolving debts there. So what you doing, man? All right, let's take a look here at stocks in the news. There were not very many interesting new highs and new lows. I already pointed out Intel as being one of them. Micron was the focus today. They jumped on the train. Right? So they saw what NVIDIA did yesterday. They said, okay, we'll take our turn here today. They lowered guidance. The problem is this is the second time they've done it in about 40 days. So they've lowered guidance twice there. June 30th was the last time they actually lowered guidance there. So they say it's even going to be lower again. Well, if you factor in those two guidance lowers there, however you want to say it, that's a 25% reduction in their estimated sales. That's a lot. That's why you see people a little frustrated there. They also have plans to invest $40 billion in a chip plant here in the U.S. thanks to Pelosi, and they basically said that straight up. Oh, QCOM also is in the news because they're going to ask for money from the CHIPS Act. They're going to be building a plant in Vermont, I think it was, to build chips here. So they're looking for money from the new dollars that we're all giving out to the chip companies. I don't know if it's a bad thing or a good thing. Just saying, you know, maybe we should make some of our chips here, but can't we let competition do it? Or why do we got to pay people to do it? Norwegian Cruise Lines, this was not pretty for them. They missed on revenue by 7%. So it wasn't a 7% reduction. We'd already expected them to lose some money or see a decline in revenue. They missed by another 7%. So not pretty there for them. Total passengers carried and passenger days, average passenger days, that also missed. Those are the two metrics people like to look at there. Now, when we get people on the cruises, the average revenue per passenger per cruise day, sorry, this is sometimes hard to remember. Now that was strong. So if we can just get people on a cruise, then they were making money off of them, but every other metric was not pretty there. You know what was pretty? Hilton. I'm sorry, Hyatt. I said Hilton. Hyatt, not bad. These guys are doing pretty good there. It was actually a really good earnings report if you like looking at this sort of thing. Revenue per available room beat by 6%. That's a big beat. It doesn't sound like a large number, but that's a big beat there. And they expected that the revenue per available room, that number will increase by another 55 to 65%. So very positive, not only with the numbers that they presented and how their quarter went, but also guidance going forward. You can't call it official guidance because I don't think they actually call it that, but very nice. Come on, man. There we go. Signet Jewelers. You ever bought anything from them? Ever bought that stuff? They were not very optimistic. The money that people spent during COVID is all but dried up there, they said. They lowered their full year guidance there, and they're going to start going into acquisition mode. They're buying Blue Nile, I believe, for like 400 million or something like that. I don't remember. But anyways, not good for them. And that is basically the stocks in the news. Lots of earnings, but not a lot of, you know, headline names there that you guys would probably ask about. So we will move on to questions. How about that? Yeah. Hey, Tanger, how we doing there? We have to pay because the new Green Deal. Oh boy, I got you guys going now, huh? I love it. You got to pay them to do chips here. Well, I mean, then what happens with oil? We need oil. You can't just run away from oil. So right now, they've taken back a lot of the subsidies and stuff. Oil companies realize that. They say, we're going to hang on to our cash. Do we now have to pay them when it comes time? Interesting. Yeah. What's your core CPI prediction? Well, I didn't see the 8.7% number until about lunchtime, but I know we already talked about it. It's going to peak. So we're at 9.1%. I'd be shocked and I'd be very worried if we climb beyond 9.1%. Like I said, 2 weeks ago in the Notes from Jazz, I basically laid out my thesis to say, here's how we can see that the number is going to pull back. What specifically, I don't know. You know, how to figure out 0.1% here and there, couldn't tell you. But I think we will confidently see a peak in inflation. There's my daily scam likely call. Yep. Semis go as techs go in the overall markets. Tech and healthcare. Healthcare's, got a big enough chunk of the S&P that it can pull some weight as well. Now, those are going to be the stocks that get, by the way, healthcare is going to be one of the sectors that if the 15% minimum corporate tax goes through, you think, oh my God, Amazon finally. No, it's going to actually hurt the healthcare stocks the most. Yeah. Get some videos on options. There are some in our client portal, research portal. There's actually quite a few in there, but I haven't done one in a while. Yeah, since COVID, really, everybody's life got busy. I wanted to help them keep the dough straight. Keep the dough straight. Here are the financials charts. I don't see anything there. You normally use the S&P to assess the market, where many news networks use the Dow. What makes one more indicative or reflective? So the Dow is the headline number. It's the one that's going to give you the big number. Oh, the Dow was up 500 points today, right? It seems exciting. There's only 30 stocks, at times 31. So we don't want to base our entire, you know, portfolio positioning based on 30 stocks that we may or may not own. So the professionals tend to use the S&P or the Russell 3000 to use as a barometer. The average like retail investor that's comparing their mutual fund to the market tends to use the S&P. The more professionals tend to use the Russell 3000 because, well, that's every large company and then some, right? So those are the top 3,000 largest companies. Yep. But in reality, there are people that say, I am a Dow investor. Well, if you're a Dow investor, you wouldn't use the Russell 2000 as your benchmark, your barometer, your decision maker. Yeah, I like it. Market is going down or sideways. Options seem like a good way to generate more income. Yeah, they can be. I have no problem with that. Even if the markets go up, it's just it's a little more work at that case. But you keep in mind that if you're selling options to be on the long side, in other words, selling puts, that yeah, you've capped your upside there. You hope the market goes sideways or slightly down. If you're selling calls, then you hope it goes down or slightly sideways. But yeah, they certainly can be. We have a lot of retirees that we handle their the IRAs and things like that, and they just like selling their calls and puts here and there. Yeah, I don't blame you. I don't blame you at all. Kareem says, I don't mean to sound very bearish, but I don't get how higher spending is good in an inflationary environment. You're just paying higher prices for things and causing more inflation. You, like you're saying, you as yourself spending, yeah, you would not be helping us all out. We all probably could just slow down and spend a little less. If you're talking about the government with the Inflation Reduction Act, the pitch is that it's technically not a spending bill, right? So they're not spending in the traditional sense. Maybe that's why they called it the Inflation Reduction Act. I don't know. It's essentially a neutral bill. We'll see. So it's not the same if you're asking about that. But yeah, if you're asking about the average person, yeah, stop buying stuff, man. We've all stopped buying cars as much and slowed down a little bit on homes, and you see the effect of those prices there. I love it. Yeah. Uh-huh. There you go. Well, I think I've done it. Answered your questions. Hopefully I've helped there. We'll be back tomorrow to do it all over again. Eric is up again for the video tomorrow, and then I'll be back on Thursday. Hope you enjoy the rest of your day. And I'm told that something new may happen here, so let's see.